G'day and welcome back. So let's keep layering in features. And now we are going to discuss bonds and more specifically bond yields and how we can use them for confirmation of trading decisions. We won't go too much into the theory of bonds and bond yields. We covered that in the course, both on YouTube and on the VectorFX website. But effectively, a bond is a debt instrument issued by government for them to fund projects, whatever it is they need to do. Central banks issue bonds. People purchase those bonds, or institutions purchase those bonds, and they get a return, which is known as the yield. And like any traded instrument, which bonds are no different, they do fluctuate in price on a regular basis. Now, what is interesting is that generally, if we have a look, say the euro currency, that there is a euro 2-year yield. As I mentioned earlier, there's a heap of different time frames for the yields, or time periods for the yields, not time frames, but time periods, and they do follow the price, or correlated to the price of a given currency. So generally, you see euro rise in strength. The yield, generally yields are a leading instrument. So if we see so the euro 2-year yield climb, we would see the euro currency do the same thing as a rule of thumb. And like everything else with this indicator or this trading strategy, we want to have an understanding or try to ascertain what is causing a currency or a currency pair to move. And we certainly do take yields and bonds into consideration, specifically yields. And we do include it's an additional feature within the indicator. So let's have a look at it. So if we come to the indicator settings, scroll down, do we see bonds and bond yields? Now, we have two inputs. So GB02Y, which is the pound yields, and the US02Y, which is the US dollar yields. What we want to do is select Show Bond Yield Spread and select OK. And you'll see this pink line appear. A couple of things worth noting. You'll notice that the line, the pink line, let's mark that out here, is flat. The reason for that is that bonds are not traded 24 hours, 5 days a week like the Forex spot currencies are. The US bonds are the most traded and have the widest trading time, but you'll typically find that instruments like the 2-year pound government bonds, the Australian government bonds, Japanese, etc., they will start trading at market open. So you will get these periods where you'll see bond yields, or the yield spread flat. Now, what we've done, I'm talking about two instruments, in this case, pound minus US dollar. Now, we spoke earlier in the course about synthetic instruments and how we created this white line, which is a synthetic spread, which is the difference between the correlated and the inversely correlated basket. The yield spread works in exactly the same way. So what we're doing is we're taking, in this case, GB02Y, which is the pound 2-year yield, and we're subtracting the US 2-year yield from it. So why do we want to do that? So let's say, in simple terms, we have Bank A and Bank B. If Bank A is offering a 4.5% interest rate or yield, and a Bank B is offering a 3% interest rate or yield, where are people going to put their money? Into Bank A, and the yield spread works exactly the same way. So we're looking at the yield of the pound currency, subtracting the US yield from the pound, and that will give us a direction. And we would generally find that yields are a leading indicator. So when they move, it's certainly worth taking notice. Now, does this work 100% of the time? No, it doesn't. But the vast majority of the time, it will give us a lot of really useful information. And effectively, we do not want to trade against what the bond market is telling us. So we're in replay mode. Let's step forward and see what we can observe. So you can see the yield spreads become active. Right, what can we see? It's very much worth keeping in mind that yields are a leading indicator or a leading instrument. Currencies will follow what bonds and bond yields do. As you can see, and I'll mark this out, yields initially go down and the synthetic spread comes up. So let's highlight that. This area here, this area here. Very often when you see the synthetic spread converging or diverging from the yield spread, you'll get ranging price action. But when you can see that the yield spread, in this case, goes long, and that the synthetic spread is also going long, that price will do the same thing. So let's continue on and see what happens. Now notice that the synthetic spread is still climbing, but the yield spread starts to flatten out. As I mentioned earlier, yields are a leading indicator. So if you were to take that trade, initially you'd take it, you'd say, yep, we have the synthetic spread and the yields going in the same direction. That's a good and a valid trade. But when you start to see the yield spread start to flatten, you may see price this up move start to weaken. We'll see what happens. No. Keep going. Right. Notice that in this case, the yield spread and the synthetic spread both turn direction. So this is a strong move. Price is following what the bond yields are telling you. Now, does this work 100% of the time? No, it doesn't. As I've mentioned in earlier videos, we don't know for an absolute certainty why price always does what it does. Any kind of instrument trading is not a guarantee. We're simply dealing in probabilities. And this certainly does increase our probability by including bond yields and yield spreads into our analysis of what is happening. So price is now turning down. Let's continue this. Now, as we saw here, when the yield spread and the synthetic spread are not in alignment or not going in the same direction, what happens? Price will tend to range. We have a disagreement. And we're seeing the same thing here now. As you can see, the synthetic spread is dropping, the yield spread has kept climbing. Yep. In all, if you drew a line down the middle here, we can do that. We can see that this entire move. Get our paintbrush tool again. their price is effectively diverging, that the yield spread and the synthetic spread are moving away from each other. As a result, ranging price action. So that is a good example of how we use yield spreads, or the yield spread, in conjunction with the synthetic spread. Now I've zoomed out so we can have a look at this at a higher level, but you'll see the best quality moves are the ones where yield spread and the synthetic spread are both moving in the same direction. So as you see in this move here, we'll see it here. This move here, price comes down. This move through here, price comes up. Some down moves in here, through here, here, here. Now, as I mentioned before, does this always work? No, it doesn't. But the cool thing about using yields is not only do they give you confirmation of an entry, but they give you when you're in a trade, you can use the yield spread as a signals to when to get out of a move or out of a trade, because as I mentioned, price very often follows what the yields do, as yields are a leading indicator. So yeah, so turn that feature on, have a look for yourself. Just price comes, they're both going in the same direction. Get the paint tool here, through here, and I'd catch this down move from about this point here. Yeah, so there's bond yields and the yield spread. So have a look at that. Now, as I mentioned, does it mean you don't take trades when the synthetic spread and the yield spread are not aligned? No, you can still take trades, but the best quality trades will be the ones when they are aligned. Well, I hope you enjoyed that video introduction to bonds and yields for the indicator and how we use them as a confirmation for the best quality trade decisions. So in the upcoming videos, we'll continue to layer on features, but in the meantime, have a play with that feature, and we'll see you in the next video.